All right, so mastering seller buy downs. First, we're going to go over rates, and then we're going to really dive into the seller buy downs and what we can do as an industry to do this well and to make sure we're not scaring sellers away. And this is going to get really technical, but it's not as hard as you may think. So I'm going to play a pretty big role in you guys making offers. So don't wing it. When you're making a seller buy down offer, I'm going to go over everything you're going to need to know. So first off, where are we with mortgage rates? So let's have a look. This is the past year on mortgage-backed securities. So I don't know if you guys remember back in early January, early part of the spring, we saw the mortgage-backed securities really rally, and we saw rates really improve, and then we fell into this, wow, inflation is a lot stickier than we thought, kind of a downward trajectory in the value of our mortgage bonds. So we see this undulation up and down, up and down, up and down, up and down, and we're right now at a very important level on this Fibonacci level. This level we bounced off this morning. So we're in a wide range right here of movement in this pattern. So if you see this pattern, we have the Fed speaking this week. This is going to be the probably most critical Fed speech we've had in a long time. What they do and what they say is actually two separate ways that the markets can be affected this week. Most people, and I'll get into this a bit, believe the Feds are going to pause. They're not going to do anything. But what they say is going to be incredibly important. So right now we bounced off this level right here. If the Feds are dovish, meaning they're not going to be as aggressive, they're kind of soft like a dove, like they're going to, that's how I remember that. They're going to be more positive and more optimistic on what the inflation numbers are and what they're going to do with the Fed funds rate. Hawkish means they're going to be very aggressively going after it and raising rates. So if you want to know that dovish versus hawkish, that's what that means. Hoping it's going to be very dovish so that the markets kind of can calm down and we can see some improvement here on the mortgage-backed securities. So we're right in the middle of this range. It's going to be very important to see what happens next. The 10-year is what I really want to show. The 10-year, we're up against this level of resistance right here. If this pierces above here, mortgage rates usually follow the trajectory of the 10-year. So if you see the 10-year going up like this, mortgage rates go up with it. So we bounced off of this right here, off this level, this 4.362. If this goes above it, there's a lot more room above that to get worse where rates can get higher. So what the Fed say this week is going to be incredibly important. So hope that like the Prince said, when the doves fly or whatever that song, oh no, that's doves cry. Let's hope that the doves don't cry. Let's hope that they're very happy as we hear what they say with the Feds this week. So expect that on Wednesday. Now, as far as average mortgage rates, here's where we are. We're in the mid to low sevens on the higher end as far as 20% down, really good credit. The more you put down, the better your rate would be. The lower your credit score, the higher this rate will be. But this is just a gauge to show you kind of where we're at. So some of you may have customers that have gotten quotes in the 8s because their credit isn't the best. That may absolutely be a possibility. This is based on conventional. VA, FHA, you're probably going to be in the lower 7s to higher 6s because they have less loan level adjustments for risk. But that's a good idea, kind of where we're at. So not the best, but that's why we have seller buy downs. Now, before we get into that, here's what's happening this week. So we have housing market index today that came out. The housing is actually quite resilient, quite strong. Year over year right now, we're at a 7% clip nationally. Different pockets of the areas have different levels of activity. We know that I saw a comment about in Fountain Hills, the activity on open houses was lower. You will see those pockets of change of just different activity depending on where you are in the valley. So that's just kind of what's happening right now. It's a hodgepodge. Tuesday, we have housing starts. We have building permits to see kind of what builders' mentality is. That's going to be really interesting. And again, bond auctions, we sell bonds to raise money, to spend money. So the 20-year bond auction on Tuesday, that's going to lead right into Wednesday. We have China's rate decision and we've got our Fed's decision. So China, guys, globally, what's happening is having a bigger impact than what we kind of want here in the United States. We want the globe to follow in our inflationary trajectories, and right now, the most of the markets on the global scale have inflation that's significantly higher than where we're at. So what they do does affect us, and that's kind of causing part of the stalemate as well. But the Fed's 11 o'clock, that Fed rate decision, expected to be no rate hikes. That's what the Feds are saying. I'm going to get into this in just a second. The Feds think no rates hike, but we'll see what they actually do. But for the most part, no Fed hike is what's going to happen here, and maybe a Fed hike in November. So let's see kind of what happens there. But again, in the afternoon after they do their decision, what they say is going to be very, very important. And then, like I've been reiterating, the employment section on Thursday, we're going to get initial jobless claims. If this comes in light, where there's less jobless claims, then that means that the markets are still hot. They're still good. And that's bad for the Fed's mentality. The Fed wants there to be pain in the economic sector in regards to jobs. They want jobless claims to go higher. So if this is a higher number, we'll see mortgage rates get better. So this is going to be a very volatile week when it comes to mortgage rates. I'm hoping on the positivity side, staying optimistic that we're going to see a little bit of help, because if we can get back into the positive move on those on the mortgage-backed securities out of this slump that we've seen for the last 8 months, 8 to 12 months, then that would be a good thing. So big week this week, guys. And these are our players in the Fed fantasy draft. So we can kind of choose who's going to be dovish and who's going to be hawkish. They're going to vote on whether or not we get this rate hike or not. But most of them are leaning towards being more dovish, which is a really, really good sign. So let's see what they do this week on Wednesday. And hopefully they'll do something that will make our lives in the real estate industry that much better. So here's some interesting information we've seen. The Financial Times actually posted a survey, and this was on 40 top economists. 90% of the economists are expecting more hikes in the future. 50% expect one more hike, which they're saying is going to happen in November. 35% of them expect more additional, so more than one hike in the future. Whereas the Feds, if you talk to the Feds, most of them agree no hike this week, and then a 50% chance of a hike in November. So Feds are actually a little bit more dovish than the financial economists that are out there. So we'll see who wins on this. We all hope that we see rates get better. Our buyers are expecting it. A lot of them are waiting for it. So it's going to be an interesting week going into this. So on the backs of that, guide to seller concessions. I want to say, do not write any offers. Do not write any offers unless you have spoken with the lender and you've gone over in absolute detail what needs to be on that, because we don't want to spook the sellers away if that amount is not needed. So we're going to go into this in detail here. But I want, first of all, to make sure you understand what the maximum seller contributions are depending on the loan type that you have. So if you have a screenshot of your camera, take a picture of this, or you can access this on my YouTube channel after we are done here. But this is a very, very, very important chart to realize. So I'm going to go through it really quickly. Conventional loans. If it's a primary or secondary home, and this is spelled wrong, that's fantastic, but this is not mine. So I just stole this from Google. But down payment, if it's primary, if it's a less than 10% down payment, you go straight across. Closing costs, prepaid items, and discount points can't exceed 3%. This is straight across, 3% of the asking price or contract price. If it's 10%, 10 to 25%, 6%, 25%, it's 9%. Okay, so primary, second home, you can go between 3, 6, and 9%, depending on the down payment for that transaction. So if you want to ask for the world, you want 6%, you can't do it unless your buyer is putting more than 10%, 10 to 25% down. If you want to go for the gusto, go for 9%, which is very significant. You have to be putting 25% or more on a primary or secondary purchase in order for that to happen. Now, if it's an investment property, you're capped at 2%, regardless of the down payment you're putting. 2% is the maximum you can ask for. So when it comes to calculating the seller buy downs, which we'll do in a second, you have to consider these numbers when doing this. This is your RPM gauge, basically. FHA, straight 6%. Doesn't matter how much you put down. 3.5% is the minimum or more, 6%. Obviously, FHA is a primary home only, as is VA. So if you are doing a VA loan, and if you're there's some interesting things here. So if you're having VA and you're including some debt to pay off, we can go cap at 4. But if it's no debt to be paid off and qualifying, up to 2 discount points, it is limited a little bit there, and then you can roll in closing costs and prepaid. So VA is a little bit more tricky. If you have one on seller buy downs on that, let me know. And then USDA is capped at 6%, again, primary only. This, guys, is very, very important. You don't want to ask for way too much. It'll really, you're going to set expectations up front. And if you ask for too much and you can't use it, it's going to leave a really bad taste in your buyer's mouth. So we need to make sure that we're doing this and coordinating that upfront very specifically, and we're fine-tuning these numbers. So let's get into the next step. And what is that? What can you roll in? So when you're asking a seller to pay for things, what can you pay for? You can actually do a number of different things. Those caps, that 3, 6, 9, that 4%, that 2% that you can max based on the loan amount, we need to remember those. But here's what you can buy down. You can do closing costs and prepaids. So that's basically all of the hard costs, the title, escrow, lender fees, appraisal fees. You can have the appraisal paid through closing and then make sure that the sellers are paying that through closing. You don't always have to have the buyer pay for the appraisal up front. That can be pushed towards closing, and then the seller is paying for that. And then prepaids are the interest that's due for the remaining month, the impounds, the escrows, those types of things. Another thing you can ask for is the cost of the temporary seller buy down, or the points for a permanent seller buy down. Or you can ask for all of this. And I want you to also understand, you can ask for a permanent rate buy down and a temporary buy down on top of that. And I'll explain that in just a second. But you can cover all the closing costs and all of the temporary or permanent buy downs all in once, or you can do a seller contribution that is just covering the closing costs. So there's a lot of flexibility. So you really need to know what you're asking for, and not just do a blanket like 3%, not knowing what the overall costs are going to be, or just hoping to get enough to do whatever you want, whatever you can. Or you can do a combination of all 3 of these, or just one, depending on what your goals are with the offer. So this is what we can ask for. And then in regards to the verbiage, I'll go over that in just a second because it's very important on the verbiage. So how do you calculate this? How do you figure out how much this is going to cost? This is where I become your ally. I'm your human calculator. Do not try to do this on your own, because this takes some mortgage IQ, takes understanding the pricing of rates. It takes a lot. So you need to know exactly where rates are for them for the day. You need to know a lot of detail. So don't just guess. Don't go to these calculators online and hope for the best, because this is a very precise number that we're wanting to do. So first off, let's jump into this. How do you calculate a 3-2-1 buy down? This is a calculator that I use, and these are the things that you're going to need to know before you know the exact dollar amount. So there's multiple types of buy downs. There's a 3-2-1 buy down. There's a 2-1 buy down. There's a 1-1 buy down. Essentially what that means is how many years are you buying that rate down? 3-2-1, 3 years. So 3% below in the first year, then 2% below in the second year, then 1% below in the third year, and then it goes to the actual interest rate, that final term for the remaining years of that mortgage. So if the rate's 7, let's just use that number, and it's a 3-2-1 buy down, it's 3% below that initial rate the first year. So the first year, 3% less, so you'd be at 4, then you'd be at 5, then you'd be at 6, and then it goes to the permanent rate remaining. Now the cost, if you can look at this, the cost is exactly equal to the monthly savings that they get with this reduced rate. So this one is based on 7.25. Okay, so we're going to go there for a second at 7.25. The first year, the interest rate's 4.25. Their payment should have been 34.10, but because of that reduced rate, it's 24.59. The savings there is $951 a month. So the annual savings for that year is $11,414.16. The next year, the rate's at 5.25. Instead of what the permanent rate would be, the payment at 34.10, it is reduced to 27.61. That savings is $649 per month. So over 12 months, over that whole year, it's reduced, or a savings of $77.98. The third year in the cycle, the rate is 1% lower, so it's 6.125. The payment should be 34.10. The new payment is actually $3,078. The savings is $332. Over 12 months, that's $39.87. You add all of this annual savings up, and that becomes the magic number that you need to ask for in order to complete this seller buy down on the 321. So $23,199.96. That's the number. If you're only doing a 321 buy down, that's the number you need to write on your contract for the exact dollar amount you're going to ask for the sellers. Can you ask for more? Yes, you absolutely can. But that additional money would be used towards additional items and costs of the transaction. But if you're just solely focused on that 321 buy down, you want to know how much it costs, that's the number. So putting an arbitrary number in there like a 2 or 3%, it won't cut it. You need to be very, very precise. Now let's look at a 2-1 buy down to see the difference. Here's a 2-1 buy down. You're at the first year savings is 2% below 7.25. So you're at 5.25. Your payment should have been $34.10. Your new payment has a savings of $649. So you're at $77.98, that annual savings. Same thing with the next year. You're at 6.125, 1% below. And you're saving $332 a month. Your savings is $39.87. You add the savings together to get the total savings, which is exactly equal to what you need to ask the sellers for, and that's that $11,785. But here's the trick. Your buyer has a very specific interest rate that applies to them based on the property type, based on their credit scores, based on how much they're putting down, et cetera, et cetera. So you need to know that exact rate and what they're willing to pay in order to calculate this. That's why you can't really just do this on your own. You have to know what the exact interest rates are by your lender. Now, if I wanted to do a permanent buy down and a seller buy down, I would then first want to know how much it's going to cost to do a permanent rate buy down to get what the rate's going to be forever, and then add that 321 buy down to this. So I'm going to go, follow me for a second here. I'm going to go to what the rates are. Here's the cost of rates right now, just a generic option. Let's just say your customer wanted a 6.75 rate. Okay, these are the costs of rates on buy downs, on permanent rate buy downs. So 6.75, that would cost you 1.947%. And this is based on the loan amount. That's why this can get tricky. It's not based on the sales price. This is on the loan amount for the lender. Here's the dollar amount. You take this dollar amount, $97.35, and then that's going to be an additional cost. And then you run this report. Instead of 7.25, you run this report based on 6.75. And now you have a lower rate. And now you compound the savings, and you have two things to ask for: what the total cost of the seller buy down would be on the temporary, and then what the permanent would be. And you can stack these. So if there's a lot of room that the sellers are willing to give because the property's been on the market for 120 days and you want to go for the gusto, you can do a permanent rate buy down. Say that 10 times fast. Permanent rate buy down and a temporary buy down at the same time. So I just want to make sure you guys were aware of that. It gets even more complicated, but this is how we actually get that number. Okay. I need to be instrumental in this process to make sure this number is right. Because if you're $300 less, it won't work. And you have to go back to the sellers to say, hey, I need an extra $300. And then the seller may be like, well, pound sand. And then you couldn't use that for the seller buy down because nobody can pay for the seller buy down except the seller. That's it. That's the only person that can pay for this. Can't come out of anyone's commissions, can't come in out of the lender's pocket. The seller is the only one that can do it. So that's a little breakdown on this. Let's go over how to calculate this. So we do the temporary seller buy down costs. So let's just say we go back to the big one. We'll put that dollar amount here on the 321 buy down, and then we do the same, the permanent rate buy down here. Then we add what closing costs we want covered. Now, closing costs are another conversation. We need to know the title, the escrow, the lender fees, all of those closing costs to get a really good estimate on how to total this number. And then you add it all up together to get what the total costs are, including closing costs and all the buy downs. And this is the number that you need to write in the contract. Try to stay away from percentages. Let's give them a really dialed in number. So seller, this is very important, guys. You have to put this verbiage in there. And you can do this separate from the contract. You can see, remarks or whatever may be. But sellers to contribute the dollar amount needed towards closing costs, prepaid, and discount points. Make sure you're adding this discount points. Closing costs, prepaids, and discount points. Put this in the contract. Then you can use whatever you get towards all of the costs that your buyer is going to have on that transaction. So this is the verbiage right here. Make a mental stamp on this, not just closing costs, prepaids, but add discount points to this. So that is my breakdown of how to position yourself with seller buy downs. And we've got some comments here, so I'm going to